Hello everyone and welcome again to Saxo's Macro Insights channel. I'm Charu Chanana, a market strategist with Saxo Singapore. Today is April 17th, 2023 and we're starting a very key week here. So I wanted to recap the bank earnings from last week and discuss what they're telling us and how we should really stack up for the earnings season ahead, which will be extremely key for markets, I believe, as we continue to trade sideways awaiting the next trigger. Now, whether that trigger will come from inflation or recession concerns picking up or from the earnings side of things, this week will be really critical for all of that. So Friday, April 14th, we had some key banks kick off the Q1 earnings season in the US. And these were a close watch for many market participants because of also the banking crisis that we saw in March with the failure of Silicon Valley Bank and the Signature Bank. So all the deposit flight concerns we had and the risks of tightening lending standards, all of these were on test to see whether the big banks really confirm any of those key trends. But instead, what we got was some very positive results, as you can see on your screens here. JPMorgan, Wells Fargo, Citigroup and PNC, all of them reported surging revenues and profits in the first quarter, mainly on the back of interest income rising due to the higher interest rates. JPMorgan's net interest income was actually up 48% compared to the year ago quarter, and it raised its net interest income expectation for full year as well. All three major banks actually denied any credit tightening. Deposits at JPMorgan were above estimates, while those for Citibank and Wells Fargo came in slightly below estimates, but still higher, making it clear that there has been a shift of deposits into larger banks and particularly into JPMorgan. PNC was the first regional bank to report, and it is worth noting that there as well, there was nothing screaming an imminent banking collapse. So things are looking pretty healthy as of now. So two key takeaways for me from here. One, the investment case for banks is still intact. The banking system may be exposed to the Fed's interest rate increases, but nothing really is breaking as of now. And two, even the credit tightening risks for the economy, they might need a reality check if this tone is maintained in the rest of the earnings season as well. But to really reach any conclusions, we still need to see more banks reporting and especially hear from smaller banks to see what scars the banking turmoil has left on them. So we had JPMorgan CEO Jamie Dimon saying that people need to be prepared for higher rates for longer, which will add to tighter conditions over time. So certainly it does look like some tightening is coming in the markets, although he also asserted that the number of regional banks likely to encounter difficulties is still quite limited. Now, PNC actually trimmed its revenue forecast last week. Now, let's see if more regional banks are exposed and which ones could those be in the week ahead. So this week, the earnings report card is getting bigger. We get more banks and a host of other companies as well reporting, which will give us a real flavor of the Q1 earnings season. Among the banks, we will be watching Charles Schwab today, which has a pretty big yield to maturity portfolio in bonds. We will be watching Bank of America and Goldman Sachs tomorrow, followed by Morgan Stanley and US Bancorp on Wednesday, and some more regional banks on Thursday and Friday. But this week is key for earnings beyond banks actually. Many big names like Tesla and Netflix are reporting as well. Also Procter & Gamble, Johnson & Johnson, IBM, ASML. So broadly, we get a first look into consumer spending patterns and margin pressures after the disappointing Q4. Before we actually get more broadly into the technology earnings next week. That will be really key as well. Broadly, I would think there are key themes on test in the Q1 earnings season. Analysts have already revised down their forecasts across sectors, as you can see with the chart on the left here. Overall earnings decline of about 7 to 8% is what is expected broadly. So that will be the second consecutive quarter of negative earnings growth, which means we might be in an earnings recession if that was really to materialize. Anyway, the big themes on test will be one, margin pressure, because cooling inflation erodes the pricing potential, whereas labor costs are still quite high. Two, we will be looking out for the impact of the banking turmoil, especially for smaller companies that are highly dependent on funding, and what this means for quality companies and the market's interest in that flight to quality trend that has been emanating for some time. And three, if the positive data that we got out of China recently on exports, on PMIs, etc., whether that means anything more broadly for the global economy as well, or rather if there are stocks and sectors that could be particularly benefited by this China reopening theme. So just thinking whether the outperformance of European equities could continue over US indices, what it means for travel and tourism demand, and so on. So let's tighten our seatbelts and brace for this earnings season, and stay tuned for more macro insights from us here at Saxo.